Building wealth is often presented as a matter of mechanical logic, an equation where you simply earn more and spend less. Yet, if the solution were purely mathematical, smart people wouldn't find themselves stalled and unable to take the first step toward their goals. Heading into 2026, the macroeconomic noise is deafening. Between shifting housing markets and the constant friction of inflation, there is a legitimate sense that the external world is becoming too volatile to navigate. When the big milestones like homeownership feel disconnected from effort, many people undergo a tactical surrender. They adopt the mindset that if the little guy can't win the long game, there's no point in playing it, which leads to using retail therapy and impulse buys as a way to cope with that frustration. Part of this frustration stems from comparing today's prices to a romanticized past. 40 years ago, a modest family home might have cost $80,000, but it was also likely 1,000 square foot space with a single bathroom. We've anchored our happiness to a standard of living that has expanded far beyond what previous generations expected as a baseline. This suggests that personal finance is actually 80% behavior and only 20% head knowledge. Your bank account is less a reflection of your math skills and more a reflection of the person in the mirror. Since you cannot control global interest rates or the national inflation index, the only path to building wealth is to stop obsessing over external factors and start managing your own habits with intensity. This chart compares debt payoff methods. Targeting the highest interest rate first makes progress feel invisible, causing people to quit. The debt snowball targets the smallest balance first. When that bill vanishes, the quick win causes your probability of finishing the journey to spike. You might pay extra interest over the long haul, but you're buying the hope and confidence required to stay in the game. It's the difference between a diet that works on paper and one that you actually stick to because you see the scale moving. Once you experience that first win, your behavior changes. You become willing to cut your lifestyle and sacrifice more than you ever thought possible because you finally believe that winning is actually an option. You cannot fix a behavioral problem with a mathematical solution. You have to lean into the psychology of momentum if you want to change your life. Managing money on purpose starts with a monthly budget. Think of this as a spending plan that gives you permission to use your money where it matters most, rather than wondering where it went at the end of the week. This requires a temporary season of sacrifice. By pausing your subscriptions and cutting back on extras, you can claw back hundreds of dollars that would otherwise be siphoned off by convenience. For those who are married, this plan only works if you combine your finances. Operating from separate bank accounts and two different sets of goals divides your household strength and prevents you from working as a single team. Combining your money forces you to communicate. It ensures that both the spender and the saver have a vote, requiring you to agree on your dreams, your fears, and your value system for the future. When you treat your income as a unified household tool, you stop reacting to individual anxieties and start making progress toward a shared vision. Effective offense is useless without a defense. All the wealth you build through budgeting can be wiped out in an afternoon if you haven't prepared for the unexpected. This graphic shows the power of diversification. Rather than gambling your future on a single stock, you spread investments across mutual funds containing hundreds of companies. If one sector takes a hit, the rest of your portfolio provides a safety net. You also have to guard against external disasters. Many families are vulnerable to a single event, like a flood or a medical emergency, simply because they haven't updated their insurance coverage in years. Beyond insurance, you need a written will. Regardless of your current net worth, having a clear plan for your assets prevents your family from facing unnecessary strife and legal confusion during a time of grief. By automating these defensive steps, you remove the constant fear of catastrophe from your daily life, leaving you free to focus on growth. The macroeconomic pressures discussed earlier are real, but they aren't the primary reason people fail. The external environment may be difficult, but it doesn't determine your final destination. Over a 40-year career, the data suggests that your daily decisions, how you budget, how you avoid debt, and how consistently you invest, have a far greater impact on your net worth than whoever is in the White House. If you're willing to live like no one else today by making difficult behavioral choices, you eventually earn the right to live and give like no one else later on. However, there is one final hurdle. After years of living restrictively to build wealth, many people find they have become conditioned to save. When they finally reach their goals, they feel a deep sense of guilt or fear when it comes time to actually use the money. At this stage, you have to intentionally build a generosity muscle. As long as your spending is reasonable relative to your net worth, you have to give yourself permission to enjoy what you've worked for and use your wealth to bless the people around you. Don't wait for a better economy to fix your life. Take control of your behavior. Follow your plan with intentionality and build a future that you actually love.